Singtel delivered a solid set of results for the financial year ended March.
And in a rare move, it announced a 2 billion Sing dollar share buyback over 3 years.
The telco giant posted net profit of more than 4 billion Singapore dollars for the year ended March, beating market expectations.
Strong contributions from its units like Optus and NCS, as well as regional associates Airtel and AIS, helped lift its underlying earnings. Singtel's operating revenue also showing steady top-line momentum. Well, let's take a look at Singtel shares. At the moment, it's now up 2% at $3.93. That's after that earnings release. And to delve deeper into the earnings, we have Arthur Lang, Group CFO of Singtel. Arthur, thanks so much for your time this morning. Now, underlying net profit there got a boost thanks to performance of regional associates as well as your units. Could you talk us through the factors that helped this strong showing, and do you expect this to continue in the next year?
Sure. Well, good morning, everyone. Nice to be on. Thank you for the time. I think the underlying net profit from Singtel, I think really was very encouraging for us. What led to the increase in profits? I think it's a few factors. I think, as you mentioned, one of our key opcos, Optus, which is our Australian telco, as well as our NCS, which is our IT services. I think both actually really put up a very strong showing this past year, growing EBIT. Optus grew over 50%. And NCS grew over 30%. And this is really as a result of very disciplined cost management, focusing on margins, and really executing well on the businesses. So I think we're very encouraged by the strong performance, especially in Optus. We have a new CEO that has just joined us probably about 6 to 7 months. I think he's settling in very well. And with NCS, I think with a renewed focus on really improving the margins of the business, improving the quality of the execution, I think this is something that is encouraging. And we do expect this to continue over the coming years. On the other side, we have our Singapore business in Singtel. That's been executing well despite the extremely challenging market environment or industry that we are facing here in Singapore. But the group actually delivered very well. And finally, our data center business, we are constructing to plan, and we have actually locked in some of the new capacity coming in, and we look forward to having the new capacity coming on board and contributing to revenues sometime next calendar year. So all good.
Singtel is also buying back 2 billion Sing dollars of its shares. Now, it's also last year, it changed their dividend policy. How do you see this balancing shareholder returns and long-term reinvestment needs?
Yes, a good question. I think it's really part and parcel of our Singtel 28 strategy, which we announced last year. I think for us, it's very important to continue executing well on lift up the operating performance of our businesses. These would include our 4 operating companies as well as our 4 regional associates. That is a given. The operational business needs to continue to do well. Having said that, we should also focus on active capital management because we actually operate in very capital-intensive industries. So we need to proactively recycle capital, sometimes reallocating capital from certain businesses to new businesses for growth. At the same time, there will be excess capital that we sometimes generate, and we are planning to return that excess capital to our shareholders. And that's why we announced this value realization share buyback program. It's the first time we've done this. It's $2 billion, so it's very exciting over the next 3 years. This is over and above the dividends that we are paying out. So last year, we announced a 2-pronged dividend, a core dividend, as well as a value realization dividend. This will continue, and we plan to grow that on a sustainable basis. This buyback, or the value realization buyback, is over and above this dividend. I think it's a 2-pronged approach. One is we want to really position ourselves as a strong communications group that is able to generate strong cash flows and be able to sustain a healthy dividend for our shareholders. At the same time, we are focused on addressing the volatility in the stock price, given the current market environment, as well as making sure that over the longer term, our long-term shareholders will continue to benefit because as we focus on the long-term value of the group. So that's where the share buyback comes in, and it's done over a 3-year period.
Arthur, Singtel sold 1.2% direct stake in India's Bharti Airtel. Can you talk about the timing of the stake sale and how Singtel views its continued strategic relationship with Airtel, given that this is not the first time that Singtel has sold some of its stake in Airtel?
Yes, good question. Our belief and long-term confidence in India has not changed at all. We believe in the fundamentals of India. Digital India is definitely here to stay. Population continues to grow and become more wealthy, and we believe in the long-term prospects of India. Despite selling just 1.2% in Airtel, we still own over 28% in Airtel. So this really signals our confidence. What we did was to just reallocate a bit of that capital to our potentially other businesses, and maybe if there's any excess, we'll return it. But our confidence in India remains, and nothing has changed. And we do believe Airtel, it has been performing extremely well for the past few years, and we believe it will continue to do so. So our commitment remains.
At the same time, Singtel's also flagged geopolitical macroeconomic risks, especially around those tariffs. How is Singtel building resilience in such an environment? Where do conditions currently put the Singtel 28 growth plan? I think it's been about a year since that was launched, especially amid the tightening of monetary policy that we're seeing globally, currency risks, and really how has that shaped the telco's capital allocation, especially when it comes to M&A, infrastructure expansion as well, for example?
Yep. Well, like every company, I think we certainly are a little bit more, pensive when it comes to looking at the current operating environment. We're definitely operating in an environment now that's a lot more uncertain, a lot more volatile. Every morning I wake up, you hear news, and things keep changing. So lots of volatility and uncertainty. But in terms of the direct impact, for example, there's a lot of discussion on tariffs, whether they'll be implemented or not. Well, if tariffs get implemented, the impact on us directly is very limited because we don't trade in goods. In fact, we provide communication services. A large part of it is multi-local, so it's really focusing on the domestic markets that we are in. Having said that, there's always second-order type of implications, right? Which, because our customers, particularly our enterprise customers, might get impacted, and as a result, it might impact our business indirectly, but there is some impact. Having said that, it is way too early to really put a number to that impact. But in terms of announcing our plans, in terms of our growth, expansion, our dividends, our capital return, we definitely have factored in this uncertainty. I would say the good thing that's going for us is that we have this momentum in terms of focusing on the operations. We have actually are continuing to improve on margins and continue to improve on the business by making, basically operating a lot more efficiently and profitably. We have also, fortunately, in the past few years, we went through a very painful process of getting rid of all the unprofitable businesses that we've had. I think you've seen we've took a few write-downs in the last 3-4 years for all our loss-making businesses. We've sold them, and fortunately we did that, so that now today we're in a much stronger position. And finally, our balance sheet remains very strong, right? I mean, you look at our ratios, we're 1.5 times net debt to EBITDA ratios. Our coverage ratios are 18 times. So even if interest rates continue to remain high, our cash flows can cover our interest expense for 18 years, right? So I think not many companies have that privilege, and based on that, we are confident, and that's why we're messaging this to the market. Having said that, we are very cognizant. We're going in with our eyes wide open. Things are continuing to remain uncertain.
Yeah, Arthur, appreciate your time with us today to talk about those results. Arthur Lang, their Group CFO of Singtel.